0.49 as Asian investors brushed off data showing US manufacturing is now contracted for a 9th consecutive month. Okay, let's get more on this now from Noor Eldin Al-Hamouri, market strategist, who joins me on the line from Abu Dhabi. Welcome to you, Noor. So, as I mentioned there, US manufacturing, 9 straight months recession. Is the market being naive, celebrating this as a rate cut signal?
I mean, the market is basically celebrating the wrong thing. A 9-month manufacturing recession is not just a rate cut signal, it's a warning. Manufacturing employment is falling, new orders are weak, and inventories are contracting. Add also to that prices are starting to go back up again. These are late cycle indicators, not early cycle ones. Yes, the Fed may cut again, but rate cuts triggered by weakness are very different from cuts triggered by confidence. I believe we are in a slow motion slowdown, not a hard landing yet, but also not a soft landing either. As long as the services stays resilient, the U.S. avoids a hard landing, but at the same time, the manufacturing data is telling us that maybe the cushion is getting thinner.
The United States just slashed tariffs on Korean cars down to 15%. Do you think that's a sign that maybe President Trump is backing off on his onslaught of tariffs, or did Seoul just get lucky?
I would say not yet. This is not a global thaw, but it's basically just targeted geopolitics. Korea isn't just a lucky exemption. It's strategically important for Washington in semiconductors, electric vehicles, and Indo-Pacific security. This tariff cuts is just a reward for alignment, not basically a shift in global trade policy. If it were a broader thaw, we would see similar moves towards Europe or even China, and we're not, at least at this stage. This economic diplomacy is just basically not a global reset for tariffs policy.
Japanese bond yields just hit levels that haven't been seen since 2008. Do you think the Bank of Japan might be about to come up with a rate hike before Christmas?
The risk of a hike is definitely rising, but the Bank of Japan doesn't want basically a shock. It wants a transition. Japanese yields are rising because inflation is finally sticky and wages growth is becoming structural. Bank of Japan's issue now is credibility. They can't just basically keep defending ultra easy policy while the market is pushing yields much higher. Bank of Japan may also may not hike before Christmas, but it can also do or use other tools by widening or removing the yield curve control. That would have the same market impact as a hike without the political noise of raising rates in December. So yes, the market is or should be prepared for a policy shift, just maybe not the headline hike everyone is waiting for.
Noor, great analysis. Thanks so much for coming on. Market strategist Noor Eldin Al-Hamouri.
Thank you for having me.
US